Hey everyone, welcome back to Mortgage Market Minute. I'm Shen with Simple Mortgage, and every week I break down the mortgage and housing market news so you can stay informed. This week, mortgage applications pull back as rates rise, geopolitical risk keeps oil markets on edge, jobless claims hit a multi-decade low, and the Fed holds rates, but mortgage rates rise anyway. Let's dig in. First up, mortgage applications. Per the MBA's weekly survey, applications dropped 6.4% for the week ending July 24th as the 30-year fixed rate climbed to its highest level since August of last year. The refinance index fell 10% for the week and was down 2% year over year. The purchase index dropped 4%. Refinance share slipped to 39.5% of applications, while adjustable rate mortgage share ticked up to 8.1%, and FHA, VA, and USDA shares each edged slightly lower. For buyers, affordability challenges remain even as inventory grows in some markets. For anyone considering a refinance, higher rates have made that math tougher, worth a one-on-one review rather than reading too much into a single week's dip. Topic 2. Oil and geopolitical risk. As of July 18th, about 14 million barrels of crude oil per day were still moving through the Middle East, roughly half through the Strait of Hormuz and the rest via alternative routes. Reports that the Iran-backed Houthi group proposed a blockade targeting Saudi Arabia raised concerns about those alternative routes, adding fresh volatility to oil prices, and oil has been a real driver of mortgage rate swings lately. With headlines moving rates day to day, stay in close touch with your loan officer so you can react quickly. The labor market. New weekly jobless claims fell to 187,000, the lowest since 1969, down sharply from the 209 to 217,000 range of the prior month. But there's more here. Late last month, the Labor Secretary directed states to tighten benefit verification after prior fraud, which may be delaying some filings. There's also a longer-term shift toward gig work, and continuing claims stayed elevated at 1.8 million, meaning people are taking longer to find their next job. So that strong headline may not capture the full picture, and that matters because labor data feeds directly into the Fed's rate decisions. The FOMC voted 9-3 to hold the federal funds rate at 3.5 to 3.75%. Futures had priced roughly a 1 in 3 chance of a hike. So holding steady looked like good news. But the 30-year fixed rate still ticked up to 6.78%, 30-year fixed 6.78%, 15-year fixed 6.32%, FHA 6.34%, Jumbo 6.9%, the 7/6 ARM unchanged at 6.34%, and VA 6.36%. The 10-year Treasury rose to 4.68%. Why did mortgage rates rise if the Fed held steady? It's about duration. Short-term rates, like 2-year Treasuries, stayed tied to the Fed funds rate and eased. But longer-term rates, the ones mortgages track, moved higher, which often happens when the market is actively debating the Fed's next move. Add overnight oil price increases, and that's the story behind today's modest rate uptick. It's a good reminder to talk through bond market context with a licensed loan officer rather than go off Fed headlines alone. Questions about how any of this applies to you? Reach out. My info's right here, and you'll find me on Facebook, Instagram, YouTube, X, and LinkedIn at Mortgage is Simple. Drop a comment, and I'll see you next week. As always, this is for informational purposes only and isn't financial, legal, or tax advice. Please consult a licensed professional.